Maria, thank you for joining us today.
Thank
I
you.
believe you characterize the current environment with its high multiples and no shortage of highly levered businesses as dangerous for private equity investors. How are you addressing that danger?
Well, I think within the context of an institutional portfolio, one would want to be much more measured in new capital that gets put out into the traditional buyout space. Multiples are reaching 11 times and higher. Debt levels are record highs. So I think that at this part of the cycle, you want to be much more reserved in the capital you're allocating to traditional buyouts. At MB Global Partners, we invest in opportunistic credit and special situations. And we look up and down the capital structure to find value. And more, we're finding value in the debt of the buyouts as opposed to the equity, because even the debt could be trading now at 70 cents on a dollar or 60 cents on a dollar, some cases lower, even for recent buyouts. So that tells you something about the value of the underlying equity, where obviously debt is the first to get paid. So if it's trading at a discount, doesn't bode well for the underlying equity.
Okay, so in terms of opportunities in the credit market, where are you finding things at this point in the cycle?
I think this is an interesting point in the cycle where we expect volatility going forward. So right now we've been finding interesting, very niche-y, very downside protected, higher yielding opportunities that will weather all cycles. And increasingly, our list of potential distressed debt and special situation opportunities is growing. And in many cases, we've either investing or are watching the debt backed by some of the really over-levered companies. And where we're seeing it's still quite pricey, maybe not quite reached our targeted entry point, but we think with the continued environment of volatility, it will reach our entry point. So again, top of the capital structure is where we see more value.
And I was going to ask you about the increased volatility in equity markets, and has it changed your approach at all?
We love volatility. We want more volatility. I think it's needed. I think it it's healthy to have some volatility in the markets. The environment that we've had the last few years is an artificial environment. It's not a real, it's a liquidity generated environment due to the monetary policy of global central banks and the QE policy globally that now even in Europe, is coming to an end. So I think volatility would be very healthy. I think that for us, it's a very good way to source deals. And during times of volatility, you really have some previously reluctant sellers being much more agreeable to your proposed price. So those bid-ask spreads close.
Okay, so we hear quite a bit about cov-lite loans. Can you explain exactly what they are?
Yeah, so typically loan documentation would have various covenants where a company would have to maintain certain ratios. For instance, the overall leverage ratio, or kind of the maintenance covenants, and so your EBITDA to your interest coverage has to be above a certain level. Because of the demand for yield on behalf of institutional and retail investors, unfortunately, creditors have been willing to give up those covenants and essentially allow companies to issue debt with fewer protections. And what's going to happen in the end is that those companies are just not going to be able to repay the debt in the end. So it's just the inevitable will be delayed.
Okay. Any other ways you see those types of loans affecting the credit landscape?
Well, I think that generally when you have spike in default rates, that also produces negative investor psychology. So I think all of that will be a contribution to an overall kind of downward spiral. I don't think that's going to be obviously as drastic as what we saw in 2008, but you certainly had an artificial market, a huge liquidity party, and as that liquidity is getting drained from the system by tightening interest rates, no more quantitative easing, you would have more and more of that volatility. You'll have naturally default rates coming up, and you'll have the potential overall slowdown in the growth cycle.
Okay. So is investing in high yield and or leveraged loans a smart way for investors to get yield in this type of environment?
I think in this type of environment, no. I think that obviously within the context of an institutional portfolio, you have to have fixed income exposure. I would obviously lean towards more bank debt because it is a floating rate instrument, so it's a better time in the environment to be in floating rate instruments, keeping in mind that default rates would rise too a bit, so credit selection is very important. So I think if you have to be a par investor, you want to be a par investor in the best credits. I think also there's going to be a very significant opportunity to buy those loans and bonds at big discounts to par value. Great environment for stressed and distressed investing.
Okay, so we're now in our 9th year of this bull market. Do you foresee a downturn coming anytime soon?
I foresee a period of okay growth, but to slower growth. Obviously, as the rate environment tightens, you will see more volatility. And so I definitely think it's going to be a higher default cycle, slower overall growth. And that's kind of, again, why there's still, I think, a time to take advantage of some of the equity market opportunities. But I think in fixed income particularly, you want to be more senior and you want to be more protected.
Okay, well, thanks very much for that insight, and thank you for joining us.
Great pleasure. Thank you.